Welcome to Looking at the Markets with David Modell. I've got a repeat guest here, but it's been way too long. It is Mr. Steve St. Angelo, a maven in the metals and commodities and stock market as well. Anything financial, I think we can talk about it. And it is Mr. Steve St. Angelo from, of course, srsroccoreport.com. I want you to head on over there, finish listening to this interview first, and then go over there. I'll put a link in the description below this video because Mr. St. Angelo has free reports you can download right now, articles to read, videos, all that good stuff. So Mr. Steve St. Angelo, welcome back to Looking at the Markets.
Well, David, thanks a lot. It's great to be here, and I'm looking forward to discuss some very interesting topics as the markets are changing faster than ever, really. It would be great also to talk about more of your insight into the stock markets and some of the trading that you do. I don't focus on that, so I think this would be a good combination interview.
Wow. Okay. Well, I'm honored. Absolutely. Now, I got to talk about this. The argument has been made that the S&P 500 will remain an attractive investment, as long as the dividend yield, which is around 2%, is higher than government bond yields. Is there any merit to this argument?
Well, I think prior to December 2019, yes. I don't think that holds true anymore. And I think the issue is, depending on how people look at this global contagion, this virus, and its impact on the markets. If you think it's a conspiracy by the elite, if you think it's overblown, or if you think it's underestimated, whatever the range of opinions, I do believe, due to the problems with the underlying system, even before this problem happened, I do believe the system was highly leveraged in a Ponzi scheme to begin with. And so now this was just a pin that popped it, but it wasn't a pin. It turned out to be a suitcase nuke. And so it's destroying it so much quicker. I saw this happening in time due to the energy, but this just sped up the process and the timetable. So I do not believe the S&P 500 will remain as an attractive investment because it's based upon growth. And so you have to have growth to allow the S&P, the Dow Jones, the stock markets to continue functioning and growing. But it's all based on oil production growth. Well, I do believe oil production growth is over for good. I really do. I don't see us going back over 100 million barrels a day. I think that's gone for good, David. So we could talk about that. So if we look at the energy that runs everything, which most, unfortunately, finance people, they tend to take for granted. I call it the energy tooth fairy. We could look at a chart that global GDP growth is dependent upon global oil production growth. You can't have one without the other. And so if oil becomes problematic, GDP becomes problematic, and so do the stock markets.
I see. Okay. Yeah, I don't want to jump around too much, but I do remember a tweet from the president, touting low oil prices. And yet I'm under the impression that a low oil price will impact not just the global oil industry, but the markets and the economy, that you can't have a robust economy with oil prices that are tanking like this. Would you agree with that?
Yeah, up until, you see, this is what's interesting about the whole economy. If you don't have energy, you don't go anywhere. We need to start with that. You get up in the morning, you take a shower, you make breakfast. You have to have energy, right? You have to. And then you get in your car to go to work. Well, you better have gasoline in your car. And then you get to work, depending on what you're doing. If you work in a manufacturing plant, it's all energy. And then even if you work in a computer firm, it's all based upon this electric grid. And all this electricity and energy continues to be consumed in the day. Well, so if you take that for granted, then you're missing the biggest picture. So the problem comes down to, if oil prices in 2000, the conventional started to peak, and they did peak, and then the oil shot up to $145 a barrel. And then it declined, and then as it went back up with all the stimulus from the federal government and the central banks, then we had $100 oil. for years, and that brought on shale. And I think your listeners need to understand that shale oil production has accounted for 75% of global oil production growth in the world in the last 10 years. If it wasn't for shale oil, we wouldn't have had the global GDP growth. So, but unfortunately, shale is only viable, David, at 50 or more. It's not viable at 50. It could kind of sustain at 50, but it's kind of viable at 60 or higher. At 20, it's a disaster. So we've added 8.5 million barrels a day of shale oil and condensate from shale, and we're going to see a lot of that disappear. So I think that's the issue. Oil prices are too low. They're going to start destroying a good percentage of the oil industry, and I don't think it's going to ever recover.
Mm. If people want more information about that, they're going to have to go over to srsroccoreport.com. There's an article on there. I'll put a link in the description below this video. Major economic depression ahead, ? Global oil demand to fall drastically. So this could get worse. And I just want to talk about, speaking of things getting worse, I mean, this contagion that's been contagious in the news. How is this going to affect the financial system, the global economy, and precious metals as well?
Well, boy, each one of those we could spend time on. I think this is the issue because we have this just-in-time inventory supply chain, and we've offshored a lot of it to China. We still haven't seen that impact yet. It hasn't. It's slow moving. It's like a 10-mile train that's going, and it takes forever to finally stop. We haven't seen the impact of this reduced supply chain, either through retail or for manufacturing, and then we're just in the beginning stages of this lockdown or shutdown of regions or countries. I mean, Italy, you probably know, Italy just mentioned that it's martial law now. And so California has done a mandatory shutdown of the state. We haven't got martial law yet. And so if that's coming, then this is really going to impact the financial markets. I believe the Dow Jones is going to go down to 10,000. I see it coming. We're at 19,000 now. It sounds if you're a technical analyst person, it doesn't sound like that would happen, but it's probably going to happen. And so, what does the world look like with that? And then how does that going to impact everything else? And then the precious metals. And we can get into this in a minute, but I do believe the physical precious metals, while they won't provide you food, while they won't provide you energy, they will provide you a store of value that may actually surprise people, because the financial system and even the money might start to get problematic. I think that's going to happen next. Not tomorrow or next week, but as time goes on, I think more and more people are going to start getting involved with the physical precious metals.
People are so conditioned to believe in V-shaped market rallies. It goes down, comes right back up. It's happened time and again, year after year. Is that realistic this time around?
No, and I think a lot of financial analysts, market timers, are starting to look at that now. I think Chris Martenson on Peak Prosperity, he's done an excellent job covering this coronavirus on his updates. He's done one, I think, for the last 56 days. He's only missed 3 days. And he makes a joke that it won't be a V shape, it'll be an L shape. And, I kind of think that's probably, an L shape is more accurate than a V shape. And so I think the issue is due to the severity of this virus and how I think it's impacting young people as well. The idea that it's just old people, I don't think that's true. I think the Netherlands is showing that there's 50% of the people that are infected in the Netherlands as of a few days ago. We're below 50 years old. And so I think as this becomes more understood, this issue that we're dealing with, the problem is that the markets have been propped up by basically printed money, and there's a long way they could fall. So I don't think we're going to see that V shape, David. And actually, when I say Dow 10,000, I don't think that's the low. I think
Yeah.
that's where we'll get to in the next month. And it could be sooner. I mean, it's amazing. We get 3,000 points in a day. You just don't know when they start saying they're going to totally lock down New York, they're going to totally lock down Chicago and other countries too, right? And so I think they were really surprised when there was another 650 deaths today in Italy alone. I mean, these are starting to get to be big numbers, and we're not going to get into too many details about this coronavirus, but I do believe the Chinese government, the Communist Party, has totally they haven't been transparent. I believe it's orders of magnitude worse in China than what they're posting publicly. So the thing is, I actually believe in Charles Nenner. You probably know who Charles Nenner is. He's calling for 5,000. That to me, especially with this, we definitely, I think we could get there. And I mean, think about this. In 2008, in the fourth quarter, the GDP fell 8.4%. By that time, from the peak in 2007 to the fourth quarter, the Dow Jones fell 42%. We're 32% now, and they're talking about Goldman Sachs is doing a 25% decline in GDP in the second quarter. JP Morgan said 14. Goldman, one analyst, is coming out with 25. If we're going to 25% GDP decline, you don't. That's got to be much worse than the 8.4% in 2008 and the 42% decline in the Dow Jones. So yes, we could easily get down to 5,000.
Agreed 100%. After a 400% unjustified gain, I'd say what we have so far, the 30% decline or whatever it is, that's nothing, in my humble opinion. And I wanted to talk about a great way to diversify and perhaps brace yourself is through precious metals. You've got an article on srsroccoreport.com. People need to check it out. It says massive surge in physical silver buying. And then it says totally distorted and broken markets. That is a must read. I'll put a link in the description below this video for people to check it out. Will precious metals provide a safe haven during a potential disintegration of the financial system? What do you think?
Yes. There's the reason I believe so is different than a lot of the alternative media, the precious metal analysts, and even the Austrian School of Economics. But all their reasons are valid at face value. You could say silver and gold been money, and so they'll continue to be money, and they've been money for 2,000 years. And we can get into a little bit more of the details here, why the paper price and let's say the physical price for silver bullion products, there's such a large spread. We can get into that. But in a nutshell, the reason why the precious metals are a store of value is because they are a store of energy equivalent value. They were 2,000 years when the Carthaginians were mining silver in Spain. They actually taught the Russians, the Roman Empire was a backwater when the Phoenicians, who basically had control of the Mediterranean 2,000 years ago, they were the big dogs back then. And they had a lot of silver mining in the Mediterranean, and then they moved into Spain. So they perfected the mining industry before the Romans were starting to build their empire. So the reason why silver and gold protect wealth is because it takes a lot of energy to produce them. Whether it's human labor, whether it's animal labor, whether it's oil, coal, natural gas, or even all the materials now. It's much more complicated now to produce these metals because all the high quality veins are gone. Now it's a much bigger project. We're basically mining gold dust. So the issue is the precious metals store this energy equivalent value, which, David, all we do in the world is trade energy. If you're purchasing a pair of tennis shoes, the value of that tennis shoe is all the energy that was burned in all stages, in all forms, to get all the materials in all the supply chain to deliver that tennis shoe in a retail store. It really is all the energy. It doesn't matter if you're buying a pair of shoes, a car, whatever. It's all the energy that went into it to produce it. That's the real value of goods and services. So they haven't changed. Now here's the difference. There's only about 2.5 billion ounces of above ground silver investment in the world. Of above ground identifiable silver stocks. There might be more. There could be 3.5 billion. But guess what? There's 2.4 billion in gold. So it's almost 1-to-1. So when the people try to actually access physical silver, not ETFs, not paper silver, there's just not that much more silver. So it'll be different because it takes 80 to 100 times more energy to produce an ounce of gold than it does an ounce of silver. That's why the gold-silver ratio is about 80-to-1. The cost is about 80-to-1 to produce an ounce of gold, and it is to produce an ounce of silver. But if you want to access real silver, there's just not that much of it. And so I could see the value of silver increasing significantly compared to gold when people start to really try to get to the available physical stocks.
Want to talk about base metals, precious metals, mining in general. I like to have physical precious metals, but I like to get some leverage in my investments with reasonably sized positions in mining shares. Is that an approach that you share? And what will the global contagion's impact, do you think, be on the mining industry?
Well, we're already seeing the impacts. Peru is shutting down mines. Pan American Silver has temporarily suspended 4 of its mines in Peru. Again, Italy is now on martial law. Is that where it ends? I don't think so. And so, is Peru going to be the only country that's going to shut down their mines? Or I'm not saying every single mine, not just due to the coronavirus, but due to impacts of the supply chain. It takes a great deal of very intricate, sometimes high-tech, and it takes a lot of materials that are transported all over the globe that need to get to the mines, like cyanide, to be able to process gold and silver. And so you need that constant supply. The U.S. water treatment industry, all the water treatment plants in the United States needs an available supply of chlorine to be able to treat the water, and those trucks have got to deliver that chlorine. So this is the issue. We're starting to see supply chain disruptions, and that's also a part of the problem. Now, 2 weeks ago, I would have said the miners are a great opportunity, and they may still be, because this thing will probably work its way through, and the mines that maybe might be shut down would be turned back on. I do see that more the case with the primary gold miners and the primary silver miners. However, I think a lot of the base metal miners that we start seeing shut down, they may not come back. There won't be the need for all this copper. There won't be the need for all this zinc and lead. And zinc, lead, and copper supplies 61% of global silver production. So to me, silver supply is going to be more problematic. However, again, David, my best answer to you after I said all that information, this is a very rapidly changing thing. I do think the miners, in certain miners, may provide a good bang for the buck because they have that metal in the ground, but it's riskier than owning the physical metals at this point in time. But it may be less riskier and more profitable, a great investment once this thing peaks and declines.
Okay, gotcha. I'm going to ask you about what's new at srsrockoreport.com. Just have one last question. I'm going to throw you a curveball here. I spoke with Lynette Zhang recently. She told me she does not own any stocks, only the metals and some other types of investments. I thought that was really interesting. Is that a good way to, is it reasonable not to own any stocks at all now? What do you think?
Here's how I look at it. If you've got, let's say, a certain amount of wealth, let's just put $100,000. and you're looking to protect wealth. This is a good time to protect wealth. This isn't a good time to be risky, is it? If you want to be risky and you've got a lot of things paid for, you don't have debts, you've got some food put away, and let's say you want to have some risk in more riskier assets. I don't have a problem with people buying stocks. However, if you've got a larger nest egg, then yeah, you could actually put more funds in riskier assets, and if you lose that, if you lose a percentage of those assets because it didn't turn out, it's not going to hurt you. If that's the way I would look at it. But I do believe that the physical metals are probably the major insurance. The mining industry or stocks, however you choose them, could be a good percentage for higher gains. But they're riskier right now, depending on how they start shutting more things down. So I think, in a nutshell, that's how I would look at it, David. It depends on your wealth level. If you want to risk more, then I would think being in stocks and certain stocks and precious metal miners, that's you could definitely put more in that if you don't mind losing it. And I'm not saying you will, but to me, I don't see the precious metals as a loser.
Gotcha. I totally agree 100%. So people can get involved on a free level with srsrockoreport.com to check out all the articles, videos, all that good stuff. But for as little as $1 or more a month, you can get some really premium content. What's new at srsrockoreport.com right now?
I'm going to be putting out a video on the precious metals, and I wanted to get into one other topic, but I'll discuss it there on this video. Is this big spread between the paper price of the metals and the physical price? And there's many aspects of why that's happening, but I do see that working its way through, especially if this contagion continues to become more problematic. There's the idea that there's all this 1,000 ounce bars. There's not a shortage of physical silver because the industrial demand has declined. Jewelry demand for silver has declined. We're not seeing a lot of manufacturing because people aren't going to stores and buying silver jewelry. So that's a big percentage of global silver demand is in those two categories. What is in high demand right now are the bullion products. So there is a backlog of that. There's a shortage of that. But in time, I think, David, a very big, or let's say, I think a high probability when more traders start getting worried about what's happening, more financial institutions, more hedge funds, they may start purchasing the 1,000 ounce bars. They're the ones who will purchase the 1,000 ounce bars. And I did want to discuss what you saw in the Treasury market. And do you have a minute to I know you don't maybe focus on the Treasury market or on the stock market, but one question I've been wanting to ask you to conclude this.
Sure.
You talked about the spreads widening, the bid-ask spreads, just like we're seeing in the precious metals, right?
Yeah.
The buy-sell is $7-8 for a silver eagle. Guess what? Guess what? The price over spot is for junk silver. It's now $9-10 an ounce. 3 weeks ago, it was 30 cents.
Wow.
So what I'm asking you is, it seems as if this situation is pushing these spreads everywhere. What are you seeing in the market, in trading, and in other ways in your information?
Sure. Yeah. Both in stocks and especially in the options world, where options have wider spreads, they're less liquid, less volume than stocks. For example, Apple stock. With Apple stock, there are millions and millions of shares traded every day. But with options, on Apple options, at any given strike price, any given expiration date, because there's so many of them, each one has only a few, maybe a handful of contracts being traded on a given trading day. So I've seen some really unusually wide spreads, which makes it difficult for people to trade profitably right now. And that is what happens when you get these weird distortions in the markets, when you get these huge market moves. And during a down move, I mean, if you own something, any type of asset, when it's falling fast, and penny stock traders know this a little too well, on the way up, it's easy to buy something. But when something's falling fast, I've seen penny stocks that when they're falling fast enough, you can't sell them to anybody. You basically have worthless paper or digital assets nowadays, of course. So I'm seeing more and more of that. You're seeing it in the precious metals and bond markets and so on. It's concerning. It is worrisome. Who's cleaning up from all this? Of course, the market makers. They pocket the difference between the ask and the bid. So they're doing just fine. Of course, they always did just fine. They don't care if markets go up or down. They clean up either way. And just because many brokers have commission-free trading and fee-free trading, that doesn't mean that it's totally free. If you're getting ripped off on the bid and then ripped off on the ask when you buy and then when you sell, you're paying through the nose, and people are making money. So it is concerning, and if there is, well, not if, when there is a big downturn, if you think you're going to sell your stocks so easily and get the current, net asset value price on it, good luck with that. That's all I have to say on that one.
And let me ask you this, because there, in Italy, I believe they came out with and I hope you don't mind me extending this a little bit, but I hope you don't. In Italy, they started banning short selling.
Yeah.
Well, you see, that's because usually if you have an illiquid market, it's the short sellers that come in and provide the liquidity. Isn't that correct?
Correct. Yeah. And so if you ban that, then that's if you ban short selling. First of all, it's kind of like when they've tripped all these circuit breakers lately. That's what that is. It's the same thing. It's the government stepping in and saying, okay, we don't want the markets going down, so no more selling and no more shorting for now. Well, what happens when they open it up to shorting and selling again? Then all these orders that have been building up, instead of being spread out over time, now they all, they storm the gates all at once. So that doesn't work. We've seen China in recent years, try to manipulate the markets in a very similar fashion. It doesn't work. So it'll work in the short term if people cannot short the markets. But what that does, once they do allow shorting at some point, because you have to have both longs and shorts. You can't ban short selling forever. The markets don't work like that. So when they do reopen it, man, it's going to be a sight to see. It's going to be historical.
Yeah, and to give you an idea, Whiting Petroleum is one of the larger oil producers in the Bakken, in the North Dakota Bakken. Mm-hmm. This thing was trading in the 20-30 range about a year and a half ago. It's now trading at $1.22. Mm. If you think about that, Chesapeake is the second largest natural gas producer in the United States. And it isn't the second by much. And I just want to let you know, I want to take a look at the quote here before I tell you, because this is unbelievable. It's trading at 18 cents a share. So it's amazing how these low oil and natural gas prices are destroying the energy industry and these energy stocks. And so I think, David, the theme I'd like to conclude here, and if there's anything else you want to talk about, that's fine. But I think the theme I want to conclude here is I think the markets and analysts and individuals are still underestimating this contagion and its impact. And I think it's like I said this before. I started looking at this 4 or 5 weeks ago, 6 weeks ago, and what was interesting, every week they'd come out, whether they're talking heads, and they would backstop and they would say something, and then a week later it was worse. And then a week later it was worse. Yeah. And every time they do something, it lasts a day, and then and so I'm kind of concerned what this looks like in a month. And so I think people just need to think about that. and just to make sure that they're prepared for this thing lasting longer than what they might realize. Because if it doesn't, then you just over prepared. But if it does, then you're not under prepared.
Well said. That's a great conclusion right there. Mr. Steve St. Angelo from SRSRoccoReport.com. He's got yearly memberships starting at $10 literally for a whole year. Basic membership $1 monthly, but he also has more premium content as well available. Just head on over there. At the very least, check out the free content. Link is in the description below this video, and we're gonna have you back here. When the Dow gets to 10,000, nobody will be celebrating, but at least we'll be able to say that we warned people. So, Mr. St. Angelo, thank you again for coming on Looking at the Markets, sir. Thank you so much.
Yeah, David, it's been great. Yes, let's set up another time, maybe in a month.
Will do.
It could come that quickly. Thank you.